Here's the thing, owner financing doesn't have a standard. The price, interest rate, down payment, amortization schedule, balloon payments, all of that stuff's negotiable. So if you know what buttons to push, you can make sure to keep cash on hand for your improvements and you can protect both sides. But if you don't know the right buttons, you'll end up inheriting somebody else's problems. In this video, I'm going to go through my bank ready checklist and I'm going to show you how to set up an owner finance deal. And I'm going to include a side-by-side comparison of two potential owner finance deals, one that can keep an extra $42,000 in your pocket and only cost you about $100 a month. So if land is going to be your legacy, make sure that you watch this because I'm telling you, structuring your deal is way more important than the sticker price. This is important because look, if you're creating a legacy here, you need to understand that typical banks, they're not your only gatekeeper in this deal. Owner financing can work perfectly, but you've got to paper it like a bank would. You got to give yourself very clear security, very clean recording, and it always helps if you set up third-party servicing for the deal. And remember, there's no standard deal in owner financing, but I'm going to talk through some things that are going to give you some guardrails to make sure you don't go off the road as you're trying to set this up. All right, first, let's talk through the three most common types of owner financing, and these are the deals that I usually see set up the most. The first one, setting up a note and a deed of trust or a mortgage. This is the one that's most like setting up a bank note. The note itself is the promise to pay back the owner. The deed of trust or the mortgage, that's what's filed. That's the lien on the property. In most states, a deed of trust gives you an opportunity to do a non-judicial foreclosure. That's the faster way to do it. But if there's a filed mortgage on it, that's a judicial foreclosure. That's going to take a little bit longer and that's going to require courts. The biggest thing about this is the title transfers to you as the buyer, but that seller, they're going to be the ones that are holding that lien on it as a first lien on the property. A great thing about these is banks recognize these types of deals, so it makes it a lot easier to refinance these in the future. And I would really look to set these up and use these if you know that your out is going to be refi and you're going to be refi ready in a certain number of months. This is the best way to go. The second type of these is a land contract. A lot of times they're called contract for deeds. In a contract for deed, the difference is the seller in this case is going to keep the title. You as the buyer, you're going to get an equitable title, but you're going to get full title once you reach either a certain milestone or that payoff is complete. The tricky thing here is if there's default, it can get a little bit muddy. You got to be crystal clear about what happens with improvements on it, and if there's any type of remedy that needs to be cured, you've got to be really specific about what those remedies are also. As a buyer, the thing that protects you here is make sure that you record a memorandum. You have to have it public so that the seller can't try to double sell it. Remember, the seller's holding the title, so there's a possibility if your recording is not public that they could try to sell it a second time from out from underneath you. And on these, in some states, the state tries to treat these like a mortgage. Make sure that you have a local attorney and a savvy attorney for setting these up, and it wouldn't hurt if they understand land deals as well. Not just owner financing, but the land side of it also. This is a good time to always bring up, if you're in Texas, I've got the attorneys here that can help you out, and realtors, obviously I'm a realtor, and anybody else that you need here locally. But if you've got needs out of state, I've got a lot of contacts in other states. Reach out to me. I can probably set you up with an attorney or an agent in whatever area you're looking. Now, these contract for deeds aren't bad, but you've got to find a seller that's willing to hold that title a little bit longer. And again, make sure that you get it filed as a part of public record. And then the third one of these, a lot of people know as wraps. And the reason it's called a wrap is because the seller still has a mortgage on it. And basically what's happening is you're going to pay the seller your mortgage to them. So basically they're taking your payment and wrapping it around and giving that money to the bank. Now, here's the trick on this. If you're going to do this, make sure you have eyes wide open, okay? Most mortgages have a due on sale clause. In other words, if I'm the seller and I sell it to you under owner financing and the bank finds out about it, they can call my note due on sale because I've sold it, and they can ask for the entire remnant of what I've got mortgaged through them all in one lump sum. Now, a lot of times if the seller talks to the bank up front, tells them what's going on, they're not going to have an issue. I mean, at the end of the day, the bank is just looking to get their money and make sure that that they're not going to get screwed on the deal. And then if that happens, the bank's going to end up foreclosing on them, but they've got a lot of money from you, so they just walk away from the deal. The key on this thing is to always use a third-party servicer to make sure to auto-forward your payments. In other words, you make your payment to the servicer pays the note for the seller, and then whatever's left over, the seller might get if there is any remnant. The reason this is important is because if you're making payments to the seller, but the seller is not making payments to the bank's going to foreclose on it. You don't get it, but you've made all the payments to the seller so they've got all your money. It can end up getting really sticky, so make sure you use a third-party servicer in this situation. And a little pro tip on here, make sure that you ask the seller to verify all of their balances, what their payments are, what the taxes are, everything that they owe, because again, if you're making a $100 payment, but their payment is $500 and they're not able to make that payment, you're not going to get your land because the bank's going to foreclose on the actual owner of it. Now, when do you use these? Well, the answer is if you can use either of the other two options, I would use those first. Now, if you're going to use this option, you have to have a plan for if the bank calls the note due. Somebody's got to make the bank whole, and it's probably going to fall on you as the buyer, so you need to have cash reserves or a way to refinance it to pay off the bank so they don't end up foreclosing on the guy that you're buying it from. Just a quick rehash on this. Okay, note plus a deed of trust. Bank friendly, refi friendly, really, really nice way to do it. Deed for sale means that you're going to end up getting that title later, so make sure that you have that filed in the public arena so that you don't end up getting double sold out from under you. And then that wrap, that's the advanced one. Again, make sure you know what you're doing, make sure you got a good attorney, and also make sure you've got a plan for if that note is called due. All right, now let's talk about the negotiation stack. What do we want to trade in what order to make sure that we're getting the best deal? And again, there's no standard in this, but there's a really good order to go in. Just make sure that you follow every step and don't get sloppy here. Number one thing you can probably guess is price. And what I like to do is lock that price in up front. Make sure everybody understands, here's the price that's going to be paid for the property. Now, once we get to terms on the price, now let's design the rest of the deal around that number. The second thing is down payment, all right? This is kind of a seatbelt for the seller. This is where they're going to make sure that they're made whole. The higher the down payment, the lower the risk for them. But for you, the lower the risk for them, the more willing they'll probably be able to, negotiate on the rate, negotiate on other terms. So the down payment is really key. One thing to keep in mind, a lot of people say, well, I can get 5% down or 2% down or 3% down. Maybe, but if that land is listed, then the seller has already come to terms with an agent that's going to require them to pay them a certain amount of money. Let's say that they've agreed to pay the agent 10%, and then you may have a normal cost of sale of about 3% on a piece of land. Okay, well, you're going to have to come to the table with more than 13% just to make that seller whole on what they've already promised out. Likewise, if they have 5% that they've allocated out, okay, now you may be able to come to the table with 10% down. They can pay 5% in their obligations already, and then they get to take 5% and put it in their bank account. So it's always a good idea to ask up front, hey, what are you going to end up paying the title company for title fees? What are you going to end up paying your broker? And find that out up front. And then you can find out, hey, if that is 5%, then you can say, okay, would you take 10% down if I give you your full ask price? But I'm also going to need to use a neutral servicer, that third-party servicer, to make sure that all these things get paid off accurately. Third part that you're going to want to negotiate then is the interest rate. Okay, and again, notice we've got price and down payment first. Those are the things that usually mean the most to the seller. Okay. If the seller gets their way on those, they're going to be a little bit more lenient on the interest rate, because right now, if you go to buy a land loan, typically you're going to be 1 to 1.5% higher than whatever a prime rate is on a residential mortgage. I'm just going to say if a residential mortgage is 6%, you're probably going to pay around 7.5% for raw land. But the thing you've got to remember is if the seller has a large chunk of money and they go put it in the bank, okay, what are they going to earn on their money? If it's a CD or something like that, they may only get 3 or 4%. Money market, somewhere about the same. So you've got a little leverage there if you're willing to pay the seller more than what they would get if they just had it in their local bank. So again, on interest rate, what I usually like to do is do something that benefits you as the buyer, that lowers that interest rate below whatever prime is for raw dirt, but also incentivizes that seller just a little bit because it's more than what they can get easily. And also, you're going to want to make sure that they feel comfortable so that they're like, okay, this is a good deal. I feel safe with this. I trust this person to pay me back. The more trust they have in you, the more trust they have in the deal, the more likely they are to allow you to go a little bit lower on the rate. Now, the fourth thing to negotiate is going to be the amortization. So in order to explain this, if you don't know, if you buy a house and you get a traditional 30-year mortgage, okay, it's amortized over 30 years. So that's basically the payment schedule. Normally with land, you're not going to be able to get more than 15 years. In some cases, you can get 20. If you go to a bank, they're typically going to only allow you to amortize it around 15 or 20 years. But they're not going to allow you to keep that same interest rate wait for that 15 or 20 years. They're going to make you, kind of refi. You're not going to have to pay all the refi, but you're going to have to take whatever the interest rate is at that time every 3 to 5 years. Okay, that 3 to 5 year period, that's called a balloon. So in this case, what we like to do is set up, hey, would you amortize it for 20 years? But I'll pay you off in full in 3. So that way the seller knows, hey, I'm going to get payments for 3 years, but then when it gets to that point, I'm not going to have to worry about payments anymore. The title's going to be transferred. I'm going to be out of it at the end of that 3. So amortization is how long that note is, and the longer the amortization, the lower that payment goes. But that balloon is the period of time that the seller is actually going to have to carry that note. Now, one little note of caution here, when you set a balloon, always give yourself an opportunity for an extension and make sure that the seller knows it's in there, because you never know what life's going to end up being like. Sometimes you might get a 90-day extension, 6-month, or even a year. But again, have that conversation up front, negotiate that out, just so you know you've got a little bit of wiggle room in there. The next thing we're going to negotiate is security for the seller. What does it take to make that seller feel safe at whatever terms you're discussing? What do they need to feel safe at 10% down or 5% down, 20-year AM with a 3-year balloon? How do you make that seller feel safe? First of all, as long as they don't owe money on the property, they're going to get the first lien on that property. Okay, so that means if you default, the property goes back to them. So that's pretty good security. But if you want to come with a lighter down payment, they may say, hey, I'm going to need some other type of collateral. I wouldn't collateralize your house, but maybe there's some other type of collateral that you can offer them, again, to make them feel safe. So again, it's a negotiation. Go back and forth with them. Me personally, I would try to make it work, just knowing that they've got that first lien position, but some sellers can be a little bit finicky about that. So you got to feel them out and see what makes them feel safe. All right, the sixth thing, again, it is a negotiation. I personally, it wouldn't be a negotiation for me, and that's making sure to have that third-party servicer. Okay, we want to make sure that the principal and interest gets paid to the seller. We want to make sure that the taxes get paid. If there's any insurance, that the insurance gets paid. Okay, this is what a servicing company for your house does. This is what escrows do. Make sure that there's enough money in there and that all these bills are getting paid, and there's not going to be some type of foreclosure that pops up when you're making payments to the seller. Again, if you're making payments to the seller, you're relying on the seller to make sure all of that gets done. That could be fine, and it's worked for years. But again, now that we have third-party servicers that you can employ, and as a buyer, I would be the one that pays for them. But now that we have these third-party servicers, I would really want to get that in between us, just so I know as a buyer that when I make a payment, it's going to the right spots. The seventh thing to negotiate is talk about what happens if there's a default and what the cure is. And a default doesn't have to mean that you can't pay for it. Let's say you're late 5 days or 10 days or 15 days. You need to have a discussion, and you need to have very specific things in writing that spells out what's going to happen in those situations. Is there a grace period that the seller is willing to give you? What's the late fee, if any? Is there a notice to cure? Does a late payment or a default for 1 or 2 months cause an accelerated payment? In other words, do you have to pay it off faster? Maybe the seller wants you to go from a 3-year balloon to a 1-year balloon if you miss a payment. And this is that situation, again, where I think it's really, really important to have an attorney working with you that understands these things, because they can make these contracts just absolutely lock tight. But again, if defaults happen, if cures happen, if any of this other stuff happens, who's going to pay for attorney's fees? Make sure that they understand. Seller, if you've got to sue, maybe there's a mediation period first, but if you've got to sue, your attorney fees are on you, my attorney fees are on me. We're not going to be going after each other for, my attorney that costs $500 an hour, which is versus your attorney that costs $8,000 an hour, something stupid like that. So make sure who pays for what happens if there's a default, how long the grace period is. Make sure all that stuff is locked up front. And then the eighth thing is, well, what happens if there's a prepayment? Personally, as a buyer, I don't want a penalty for prepayment. If I want to go to a bank and refi that thing in 6 months when I've got a 3-year balloon, okay, the seller should be happy with that, right? I'm giving them all their money. They don't have any more risk. They're down the road. I'm down the road. So I don't want a prepayment. But some sellers may want a prepayment because if you pay it off within the first year, maybe they incur some type of additional tax hit or something like that. So have these conversations up front, again, before you sign anything. And then the last thing to talk about is, okay, are there any potential special situations that could pop up? And again, attorneys are going to have a ton of these, especially if they're familiar with the space. But here's some special cases that you might run across. If you get a future construction loan, is the seller willing to subordinate their loan to the construction loan? Or if you get a construction loan, are they going to require that you pay them off and get them out of the deal? Are there any partial releases? Let's say you're buying 100 acres and your plan's to subdivide it into a 50-acre piece and two 25-acre pieces, but you want to sell the two 25 acres. Okay, well, is the seller okay as you sell those to give him money and then he'll release that land to the new owner? You've got to have those releases if you're planning on subdividing and selling before the end of your note. I always tell you to talk about what the end goal looks like in that next chapter. Well, this is your chance to solve for surprises or whatever's happening in that next chapter up front before you ever get there. All right, now, like I mentioned, I want to give you a little bit of a case study. So here's what we're going to look at. We're going to look at a piece of property that the seller's asking $500,000 for. Okay, now we're going to look at the two different paths that you can get to, to buy that property with owner financing. Okay, so the first path, we're going to say you're going to go to a local bank, you're going to get a loan, and you're going to take that bank loan to buy this property. So you're going to go to the seller for that $500,000 property. You're going to negotiate down to $460,000, so they're going to take $460,000 for it. You're going to put 20% down with your local bank. That's $92,000. You're going to take out a loan for $368,000. Your payment or your interest rate is $825. You've got a 20-year amortization. So your principal and interest is $3,135 every month. So you're having a $3,135 payment, and cash out of pocket day one is $92,000. So keep that in mind. Let's look now, what would it look like under a potential owner finance, something that's going to be a better deal for the seller, but also a better deal for you as the buyer. All right, so in this owner finance deal, we're going to give the seller their $500,000. That's fine. We're not going to worry about negotiating it down because we're going to get a better deal overall. So what we're going to do is we're going to say 10% down, which is going to cost you $50,000. You're going to take out a loan from the seller for $450,000. But you were able to negotiate a 6% interest rate on that same 20-year amortization. So your principal and interest now is $3,224 a month. That's $88 more than what you were paying with the bank. But here's the thing. Remember, your cash out of pocket is only $50,000. So what did you end up doing? Well, you're paying $88 more a month, almost $100 a month, but you're keeping $42,000 extra in your pocket. Okay, now for $42,000, go drop electric on for $10,000. Go put your septic system in for $15,000 or $20,000. Go get, go start putting in your driveway. All of these improvements are going to make that land more valuable so that when you go to refinance it with a bank or get your construction loan, you're actually going to end up with a higher appraisal, which is going to end up being more beneficial to you in the long run. So you paid $40,000 more for the property, but at the end of the day, you kept $42,000 in cash in your pocket, but now you've got a property that's more valuable when you get to the point where you're going to start building whatever it is you're building on that property. That's where a lot of people get hung up on that sticker price, right? They think a good negotiator is going in and trying to get as much off of the sales price as humanly possible. But if you think a little bit, if you put a little bit different plan into action, you can actually come out way further ahead on your side of things, even if you just give the seller what they're asking for in terms of their sales price. Now, don't give them more than market value. I get that. But let's, as long as they're within market value, a lot of times you can come out way farther ahead. The seller's going to get how much money they want for the property, plus they're going to put interest in their pocket, everything else. It's a huge win for the seller. But again, because you can actually make that land more valuable while the owner's holding the note for you, you come out way ahead as well. Man, sun came out after that rain and it got real hot, so I had to go find me some shade to keep going. So moving on, let's talk about what kind of guardrails we can put in place to protect you through this thing. The first thing is make sure you record everything in the public, whether it's in the county, with the state, the city. Talk to the attorney that you're working with and make sure that it's recorded. Deeds, deed of trust, at least memorandums, something. Make sure that it's recorded to protect yourself. Talk to the attorney that you're working with. Make sure it's a local attorney. They'll know where. But record the deeds, record the deed of trust. If it's a land contract, make sure you record the memorandum for it. Make sure that you're protected by recording what you wrote on a piece of paper. That piece of paper is not worth anything if nobody knows it exists and the courts can't reference it in the public file to protect you. Again, and I've mentioned this a few times now, use a loan servicer. I know you may trust the owner, your family may have known the owner for a long time, but what happens if that owner passes away and then it goes to their family and now all of a sudden they stop making payments on it? They're just collecting your money. Okay, that's an issue. Use that third-party loan servicer. Yes, it's going to cost you a little bit more, but here we're talking about protecting yourself, protecting your assets. Another thing that can help protect you, and use that attorney, that local attorney to help you with this, make sure you understand your state's usury laws and your late fee laws. Do not wing this. You got to know what the penalties are here. So again, make sure you've got a good attorney unless you're an attorney yourself. And then again, I'm talking about it again because it's important. only use a wrap if it's a last resort on this, and only use it if you've got a plan B if that original lender calls that mortgage due. You've got to have an opportunity to get that thing paid off quickly. You're not going to be able to pull money out of investments that's going to take you 7 or 8 months to get. You're going to have that money available, and you're going to have to make that note whole very quick. So again, not for everybody, very advanced, but if you do have the know-how, you've got somebody that can walk you through it, and you have the ability to get that loan paid off now, okay, it's an option. And now after saying that, this is a great time for me to remind you, I'm not an attorney. I'm not licensed to practice real estate in every state. I'm giving you my experience as a realtor who has seen these things happen. But again, I'm not legal counsel. I'm not a title company. You need those people on your side. Again, if you need them in your state or wherever you're looking, and you don't know those people, reach out to me. I can help you find them. But again, not legal counsel here, not giving you legal advice, just giving you a step-by-step process of things that you need to do. Now, this next section, I just want to give you a step-by-step blueprint on this. All right, first thing, make sure you understand what's happening pre-deal. Make sure you have access to the property. Make sure you understand where utilities are coming from. Make sure you understand the zoning. Are there any floodplains on it? What are you going to do for soil and septic? What are you going to do for water? Okay, and if your exit is a bank refi, make sure you're talking to your future lender now. Don't wait for it down the road. Okay, if you know that you're going to be refining out, you may as well be talking to them from the beginning. Second part of the blueprint, you don't have to go into a contract immediately. You can submit an LOI. An LOI is a letter of intent. It can be 1 page. You just need to have the terms on it that you're offering to the seller. What's the price? What's the amount you're putting down? What's the interest rate that you're offering? Amortization period. When does the balloon come due? How are we going to handle escrows? What's the cure period? What are the special clauses? What happens if there's, do you need subordination? Can they be okay with partial releases? And who pays what costs? All of that stuff can go into a 1-page LOI. And what I would do in that LOI is I'd give them a scenario and compare the two situations just like I did first. Hey, look, if you take my owner finance deal, I'll give you $500,000. You're going to make 6% interest all down the road, right? But if you don't want that deal, okay, I'm going to go to a bank. I can only pay you $460, and you're not going to get the extra 6%. And if you put that side by side and hand it to the seller, most sellers are going to be really willing to take a look at that and consider that. If they're like, oh wait, I'm getting $40,000 more now, I'm going to get 6% interest for 3 years. A lot of sellers are really going to they're going to think hard about it rather than just taking that lower price right now just because they don't have to worry about anything else. Especially if you can explain to them, hey, we're going to use third-party servicers, so you don't have to worry if I default on the loan, they're going to make sure to foreclose on me. The seller doesn't have to foreclose. And that's the thing about third-party servicers. It's not just to protect you as the buyer, but it protects the seller also. The servicers, like I said, if you do default and all the cures spell out that it's time to foreclose on you, those third-party services are going to be the ones to foreclose on you. Seller doesn't have to worry about it. They're just going to get their money or their land back. Okay, with that LOI can go back and forth a little bit, but the third part is then get the deal on paper. All right, make that purchase contract, seller financing addendum, and this is something that I highly recommend you have an attorney do. You're going to have to draft a promissory note or deed of trust, mortgage, or a land contract. There's going to have to be a servicing agreement, so you're going to have to get those people on board. But once you get to agreement on the terms, get with your attorney and get that deal on paper. Now, the fourth step here, this blueprint, is once we've gotten through due diligence periods and everything like that, got surveys taken care of, make sure you get a new survey. We got all that stuff taken care of. Close this with either an attorney in that state or a title company, whatever your state recognizes as the people to close a deal. That way, again, we make sure all of these notices are in public, everything is filed publicly, and you are protected from that standpoint. And then the fifth part is post-close operations. How's this going to happen? First thing, set up auto draft with your servicer. They can set it up just like any other bank. They can pull it directly from a bank account. That way you don't miss your payments. That's number one. Don't miss a payment. Also, if there's structures, you're probably going to want to add the seller as additional interest on the insurance policy just to make sure that they're covered as well. It's more for their benefit than yours, but at the end of the day, we want to make sure everybody's getting taken care of here. We don't want lawsuits. Those things tie up land and tie up processes and can take years. So let's make sure that if you've got insurance on the property, the seller has partial interest in that insurance. And then in whatever area you bought in, make sure you know when are taxes due. Sometimes they're due twice a year, sometimes they're due at the end of the year, sometimes they're due at the beginning of the year. Make sure you understand for for that area when those taxes are due and put it on your calendar so you don't miss a tax payment. Again, we want to make this good for everybody. We don't want people hiring attorneys, having to sue, go to mediation, things like that. That just screws up deals. Make sure you know your timelines and when payments are due. And then if your goal here is to refinance this property eventually, maybe it'll be a construction loan that's going to pay it off, or you're going to put improvements in place and then take out a loan on the improvements. Whatever it is, if you're going to refinance it, make sure you have that timeline in mind and start the paperwork for the refinance 15 to 18 months ahead of time. Be working on it constantly, be updating your documents with the lender so they know what's going on. Whenever you put improvements in place, notify the lender. Don't get that appraisal until the very end. There's no need if you're putting improvements in place, but be working on that refi over time leading up to when you're actually going to get the refi. Just makes everything a lot easier at the end. And at this point, you're probably wondering, like, geez, that's a lot of work. And it is. This is what banks do every time they give a loan on anything, whether it's a house or a car or a piece of property. But that's the whole point. We want this to look like a bank did it, because banks protect themselves from borrowers every time they give out money. That's what the seller wants to do, and that's what you want to do as the borrower. You want to protect yourself to make sure the seller does what they're supposed to do. The seller's trying to protect themselves against you. So yes, this is going to look like a bank loan at the end of it. That's what we want. Now I want to take a minute to talk about some common mistakes that I see. The first one, we talked about it a little bit earlier, is having a balloon, okay, 3 years or whatever that balloon period looks like, and then not having a plan after that. Because again, life happens. Maybe you can't refinance it in 3 years. You might need an additional 6 months. You may need a year. Make sure you have opportunities for that in the contract. Have it set up from the beginning. Second major problem, again, we've mentioned this, is not recording the deed or the memorandum or whatever paperwork that you put into place for this sale. You don't file it. Make sure it is filed the day of closing. If you've got an attorney or a title company, they're going to take care of that for you. If you're doing it on your own, make sure you file this stuff as soon as humanly possible. Again, this is protecting you as the buyer. Make sure everybody in the public sphere knows that you bought that property and you've got the documents to prove it. Another common problem is not having that third-party servicer. When you've got it set up, you set up auto draft, you don't have to worry about telling your wife or your husband, I thought you made the payment, I thought you made the payment, holy crap, we're 3 weeks late, whatever, and then going into reaction mode. Having that third-party servicer set up, you're going to get emails, you're going to get notifications via mail, all of that stuff's going to be taken care of. Pay the extra money to set up that servicer. Another major problem I see is people thinking that they have to get the lowest payment, lowest payment, lowest payment. I showed you earlier. There's a way that you can pay more and still come out way ahead. At the end of the day, if you've got things that you're wanting to do on that land, if you're wanting to put improvements in place and you don't have an infinite supply of money, keeping as much cash in your pocket as possible may be a little bit higher payment, but it's going to be worth it in the long run. And then the last major issue, again, are those wraps that are just casual. You don't have the cash to pay it off if that lender finds out about it. Sure, if a lender finds out, calls that note due, y'all may be able to go in, you as the seller and the buyer together, and make that lender feel okay. And the lender's like, okay, as long as it's getting paid, we're fine. You might be able to do that with a small lender, but it's a lot better if you have the ability in reserves that if that lender's like, nope, you got to pay it off as a due on sale clause, we want our money now, you as the buyer have got to have the ability to pay them off. If you don't, please don't go into a wrap in that situation. And when you've got all this done, and again, I'm not an attorney, I can't look at documents, but as you're working through this checklist, if you want a set of eyes on it, let me know, give me a call. I'm more than happy to look at it. Or again, if you need recommendations for loan servicers or attorneys in your area or realtors, lenders, construction contractors, anybody in your area that you need a recommendation for, let me know. Chances are I know somebody, and if it's in Texas, I guarantee I know somebody. It's me. So anyway, give me a call if you need help with that. That's what I'm here for.